Hey, Ryan, why don't you pull up Amazon's margins real quick?
Well, yeah, I'd have more of a grin on my face than Stephen Hawking on Epstein's Island.
I'm off as a smug cock when he said that.
Wow, fiscal philosophy, you're not very smart at all. You screw up, cash flow kings. Dissector, you are an idiot.
Hello, everybody. It is Saturday, and it's 8 p.m. Eastern. It's Saturday, 8 p.m. Eastern, especially after Black Friday, you could be doing some treacherous things.
It's true.
Fiscal, what are some of the things you could be doing during this holiday season?
Well, if we're going to keep it on theme, you could be maxing out your credit card, maybe even your Robinhood Gold credit card if you're one of the lucky few who has that. Not sponsored, by the way. We should be.
Yeah.
You could be stuffing more than just turkeys. Who knows?
Oh, that's something. Yeah,
exactly.
I wouldn't want to participate in personally.
But you could be binge eating. It's a stressful time, the holidays, and everybody's got leftover turkey and whatnot in their fridge. I'm sure there's temptation. Maybe to have too much pumpkin pie, et cetera, et cetera. You don't want to do that.
You could be going to the mall and engaging with the people that want to clean your shoes, the shoe cleaner.
Shoe shiner.
Could have happened today.
You could also be that person at the dinner table who initiates the, say, political discussion.
Would anybody like ice with their drink? Speaking of ice, the good old classic. Yeah. Wouldn't want to do that.
Yeah.
There we go. Oh, speaking of, before we get to the topic of tonight's episode, we have 3 giant thank yous. First of all, we don't know who you are, but thank you to whoever signed up with our code to finchat/fiscal.ai. It helps a lot, way more than I thought. So appreciate that very much.
That's true. If like 10 people did that, it would cover like all of our expenses next year.
I don't know. I think it would be like maybe 5 or 6. It was
StreamYard's expensive.
That's true.
Not cheap. Yeah.
Thank you though very much. We do appreciate that. Also, we have a new channel member too, actually, which is Chimi124, and wait, that might be Blake. He almost became a member, so we can dance for Chimi and the person that used our Fiscal AI code. Once again, link in the description. Also, Blake is on something. He almost became a member. We did do a little exclusive Twitter Spaces this week. If you can't catch it during the week, sucks for you because you have to pay the $2 a month in channel memberships. Good old capitalism we love on this channel. If you can't join in the middle of the day when you're probably at work or at school, then you have to pay for it. So $2 a month. It was pretty much a good like CFK midweek episode. So enjoy that. 10-second recap. We just think it's if you want to, okay, Blake, just as a token of appreciation, we think it's really cheap still. We talked about some catalysts.
I think it's cheaper. I think it's probably cheaper today than it was when it was like $1.80 US earlier this year. If you take into account forward earnings and especially adding in the Remexian deal, basically.
Yeah, that was the big takeaway. And and how like the irony of people, like once it got to like 350, 360, the people were like, they're like, I'll be a consistent buyer until this thing hits $15.
Everybody's a barnacle when it's up 70%, but
good episode though, and there were a few other names and tickers discussed. Last thing, Cabo wants our thoughts on Khmer going all out of yield max and removing margin to go. I don't even know.
What the fuck's Granite, Paris? I'm sorry, I don't know what that is.
Love our channel members, but I can't.
Is it also high yield dividends or like what?
I would assume.
I mean, if it's the same theme where they're just trying to put a huge sticker yield on the thing, it just means that he's learned nothing. Yeah. He's blaming the fund and not like his general strategy. It's not the fund's strategy that's flawed; it's his own. Well, the fund's
yield. Oh Jesus, no.
Yeah. So he just hasn't learned anything, is what that tells me. To be honest with you, he's blaming the specific fund instead of his own stupidity.
I'm still waiting for Trump to appoint him as the next Fed head. All right, we do have to dance before we get to any fun conversations for our token of appreciation. So here we go.
Round two, here we go.
Thank you to everybody that has financially supported this channel. All right, on to our episode of the night. Once again, if you do want to join in your PayPal bag, you have any thoughts, let us know in the comment section. We will post the link. Last time we posted the link at the beginning of the episode, we lagged out mysteriously. First guest is somebody who's been on the show before. He's a controversial figure in the Discord community. I heard he really likes Donald Trump. His name is Beater Stocks, aka Dr. Pump. Welcome in, Beater.
Oh, what's up?
Uh-oh.
I see he didn't invest in a better microphone.
No, I did. It's not working?
It's a little better now.
Okay, cool.
Okay. And the next and last guest, for now at least, Dan may be potentially joining. It is Capital Mindset, Mr. Fabio, Dablio. Any other names? Yeah, there we go. All right. Everybody here besides me owns PayPal. So this is the intervention, we could say. Try and convince Ryan to sell out of all of his Amazon at these nice prices and put it into PayPal.
Hey, PayPal has, except for in the last few days where it was a little bit lower, it's basically never been cheaper, as a matter of fact.
So, yes, but and to be fair, cheap can stay cheap for a very long time.
I've learned.
As you might have seen. But there's a lot to, I guess, get into it. But where do you guys want to start?
We'll start with the good old classic roundtable question. What's everybody's current allocation and status of the company with the current share price?
Okay. Across accounts, 400 shares common stock, 2 leaps, and that's it. Yeah. And percentage wise, it's one of the bigger ones now. I got assigned on. I sold a couple cash secured puts like a couple weeks ago and got assigned on them both. And it didn't really look particularly worth it to roll them because my cost basis ended up being like $64 or $65 or something. Who cares? At that price, I feel very secure with PayPal.
You could buy another company for $65, just saying.
Yeah, true.
Fabio.
Oh, me? Okay. Yes. So I'll speak here on behalf of Fraxinus for this.
Oh, yeah.
So for full disclosure, I won't say like the dollar figures or anything like that. I'll refer to it in terms of like, relative allocation sizing, but we have a position in PayPal. It's currently actually our smallest position, expressed in leaps. So that's, in terms of percentages, it'd be low single digits. But we'll kind of explain as to why when we get into it. But I'm still bullish. I think it's one of the most fun stocks to talk about recently among the retail love stocks because it's so controversial.
That's the one. Yep. All right, Peter.
Yeah, I showed you the screenshot dangler. I think I'm like 370 shares right now.
370?
Something like that.
I
think it was like, I don't know. Something like that.
Yeah, I'm taking a peek right now. There we go. Everybody's cost average around this price. Fiscal, you may be a little higher.
So not really, because my first 100 shares was at 59 in 2023.
I remember.
So I've only averaged up recently.
That's fair.
But I'm in the 60s. So I'm overall, like the blended cost average on the shares. The leaps I'm taking a little bit of a beating on just because they decay over time and stuff. But they are all they're all 2027 as far as the date. One's January 2027, the other is December 2027, but they both have well over a year. Well, over a year on them still, so I'm not too worried.
Yeah.
And for us, we at Fraxis, we purchased these Leap contracts when PayPal's share price was in the mid to high-ish 60. So I think it was like 67 a share. And our strike is at 67.50. And then the expiration is December 2027. I was actually pulling up to see how much we're down on these. Oh, we're not even that much down. I thought we'd be down more. So that's
Bold man to come onto the Cash Flow Kings and talk about how much money that the clients are losing right now in PayPal.
Yeah,
The smallest allocation.
Yeah, they're literally losing dozens of dollars on it because it's such a small position.
Yeah,
dozens, maybe not dozens of dollars, but
okay, hundreds of dollars, maybe even scores. I don't know.
It's down roughly 14%.
No.
So with contracts, that's like, you know, any other week that could reverse. But
once again, actually, I got to be very careful with these jokes I make regarding the fund. I have to be very careful. I'm not going to do it.
He just has to be careful with his poker face when you make the joke.
Yeah, I see.
No, it just can't be jokes of like actions. Remember?
Oh yeah.
Any other kind
Once again, to invest, you need $250. You need to have a credit history of a year,
sign me up.
a home, and a barn.
Those jokes are allowed. That's perfect.
Yeah, we can make fun jokes like that on the show. Yeah. Do we want to talk about everybody's the thesis we have for this company? Fiscal, you want to start?
Well, I think a lot of it has to do with the fact that this company is due for some margin expansion, some reacceleration in their Braintree business. The monetization of Venmo bodes well for them, and I think that there's something to their advertising business as well, as far as more new revenue coming in, high growth, high margin.
Yeah. Fabio.
So I actually, for myself, we don't really look at the advertising business too much, although it is interesting. It could be interesting. But what we find fascinating about PayPal is it's this company that, you know, if you guys don't know, if the audience doesn't know, but I know you guys know, I was a PayPal bear for quite a long time. I remember Beater, you know, our conversations back in the day. Right?
Yep.
But now
you're right. You know.
Well, I was right-ish because you were also right that the new CEO was going to make changes, which I changed my mind seeing the results. Although the market hasn't really fully appreciated them thus far. And what we like about him, especially, and this is like from an operator standpoint. So we get this a lot from how he talks about the progress they've made. And this is very keen on, you know, what dealing with other operators in the past. And one of our partners who is in this world, I'll paraphrase our discussions, but just to say that he comes across, when I say he, the CEO of PayPal, he comes across as not wanting to celebrate too early. He wants to basically put pressure on the team, on the employee base, to still strive for more. And he actually said as much in a recent interview, which kind of confirmed that conversation we had between us partners, that is exactly how he's thinking, because he literally said it. He says he doesn't like to over celebrate or basically be in a position where you're like, oh, patting yourself on the back. Because what happened coming into it, and this is actually the fame they garnered within the fintech space, is that they were full of people that were just like, you know, stumbling themselves into success. And that bred a culture of, you could say, this work ethic wasn't really there anymore. It was complacency across the board. They're just like, we had a right to win, period. But that's not true anywhere. And so that led to a lot of the problems that they eventually kind of stumbled into. There was, for example, I'll give you some specific operating problems that they had. Venmo was this wonderful asset with this incredible user base that they were just not monetizing. If you looked at who the demographic of Venmo is, there's a lot of ways you can kind of upsell that. They had a large dominance in these major cities. You know, for example, in New York City, that area is mainly dominated by Venmo. This lack of attention to this asset was notable. And that was one of my points of contention back when I was a bear, where when I was looking at this and saying, like, why is everyone so excited about this business? And of course, you had the declining take rate, but the declining take rate actually to the bears now, it's not that as much of a big a deal as you think about, because what it is their white label product is growing a lot faster than their branded checkout product. And the white label product, if it was spun out, going to our bull thesis, right, it would be a lot more valuable or given a lot more credit than it is right now as part of the overall PayPal, which Braintree. Braintree is more of a competitor to think of, Stripe and Adyen. And what's interesting about Braintree before the new CEO came in is that they were taking market share just by, giving away services at whatever margin, whatever cost. Now, what I like about the change was, of course, we're going to switch over to more profitable arrangements, more arrangement that makes sense. Adyen talked about this back in 2023, saying what they were having trouble growing because they had a peer that was just, saying, oh, we'll do it for almost any price, which was the wrong framework, and more so gives you an idea of how the previous management thought. And so they had all these assets basically that were being mismanaged. The bull thesis is that that's no longer the case, but for that to really sort of manifest, I wanted to see this last quarter, and I was going to admit defeat, wave the white flag if in this last quarter we didn't see that. I think we did, but it doesn't take one quarter for it to fully show up, right? You see the signs of it. The market won't see the signs of it just yet. That will come in the next couple quarters, really. And so you have a chance to kind of see if they stumble. And if they stumble, you can revisit that, because then it could be like, okay, that was just one quarter. And that's where maybe the market's right in being a little bit precautious, but or cautious, not precautious. But as an investor, we can kind of, try to think about strategizing the position sizing and saying, like, a little bit now, maybe a little bit more later, and then even more later. And then if you're still, looking to add yourselves, also, you can consider it more of a buying opportunity. But at the very least, like the multiple is not demanding, right? We're trading at, low double-digit multiple. So really, you just have to focus on, is the core business not deteriorating? And then if these other growth verticals start to actually pick up steam, then you're off to the races. This could re-rate very quickly. That's what the setup is right now. The sentiment is so poor, a re-rate could happen very quickly. So I can't afford almost not to be in the name if I'm bullish. But at the same time, you're almost like, is it a fluke quarter? Is it not? That's like where I'll be fair and say, like, those are where the doubts might stem from. But a lot of my bearish points that I had before, when I would consider myself like more of an OG bear, when it wasn't cool to be bearish PayPal, those are gone for the most part. So yeah.
Dr. Pump, would you like to share some of your thesis?
Yeah, it's kind of similar to Capital Mindset here. They're kind of a large toll booth company that had bad management. They kind of got away with just kind of not really innovating or doing anything on their platforms under Schulman, the last CEO. And they still had insane growth, insane stock price appreciation. During COVID, they didn't really have to do anything. If you look at like the old PayPal, they had like no good rewards. It was like 4% off some like luxury jewelry or something. So they weren't really working too hard. And then the new my bull thesis is the new management is going to come in, improve the platforms. They're focusing a lot on like their core branded experiences, which branded checkout is a part of. And it is bearing some results. You're seeing debit card use go up. The apps have a lot of like good rewards in them now, like this new 5% off a category thing. So like I actually think it's really cool. You can pick a category like groceries, get 5% off. Obviously, I think it costs money, but it's getting more people into the platform, get that user count up. It's still user count's not going up that fast. I thought it would be up a little bit faster now, but it's still growing. That's good. And yeah, they're focused on like Venmo, pay with Venmo debit card, PayPal debit card. Those are all huge. Buy now, pay later. Those are all huge growth opportunities, and I think they're doing a good job of that. So I like where it's going.
I actually liked PayPal like during 2019, 2020. When I was at 300, I mean, I knew nothing about investing, but as a customer, I enjoyed using it, and I could see where people would actually use it in the real world. Peter, you are a little robot-y soundish.
Yeah, I don't know if it's you're too close to the mic and it's
It
crackling.
may not be
Yeah,
fully
I don't know. I tried using my phone this time, but you guys are sounding robotic to me. So,
whoa, it's fair.
It could be a signal thing, though.
Yeah,
Maybe.
share some empathy, everybody. Let's see. Reading the comments right now. Elias thinks that float is going to get deleted over time or a re-rating. No in between, that it just stays between 60 and 65.
If there's no deterioration in the core business, this is true. This is only true if that's the case.
Yeah.
Because if there is, then those buyback stories, they're not going to go your way. Now, that being said, as a buyback story, what makes PayPal intriguing is they aren't very levered. Buybacks, for the most part, are extremely sustainable at the current cadence. We could even see them implement a little bit of leverage. It wouldn't be that detrimental, but although the pace that they're doing right now is fair and healthy, and I would argue responsible. The dividend implementation I found perplexing. I was like, did they listen to that one YouTuber who asked for a dividend? I was like,
there was a guy on Twitter that was like flipping out about they need to do everything they can to pump this to 77 so that because of the chart it'll then go to 120. And it's like, bro. And he was like tagging. I showed you this, didn't I?
Yes, you did.
Yeah. What a freak. I don't care one way or the other about the dividend in case it's not totally clear. But what do we all think about PayPal World?
Oh, the integration of all the platforms.
Right. Yeah.
I think it's I'm yet to see the long-term, fruits of that right now in the numbers.
Right.
Like, you obviously can't really see that, but it's at least moving in the right direction where they have these assets and it's just figuring out how to combine it all into one where you can make it seamless for your customers to use all these other, let's say platforms, and not have this like friction that exists. I think there's a lot of potential in that. But obviously right now we don't really, we're just talking about this as like a future endeavor, which is interesting because if that's actually what brings up the branded side, that's what the street will actually reward, by the way, because I think that's clear now. The street really does care, even though these other things are moving in the right direction. The street does care a lot about branded.
And what if, because I don't know if anybody saw the news. I know I'm not much of a crypto person, but
Jesus Christ.
they have their own stable coin, and the way to make something like a PayPal World work with all of the other platforms that they're going to potentially be partnering with globally, it might be to settle those things in their stable coin on the back end to make that seamless. Because when I don't know if you remember when Alex Chris was kind of just talking about what PayPal World will be in the future, but it was something along the lines of, you have whatever wallet you have, you go to another country, they have a completely different wallet. And you have no way to seamlessly send money to each other or tap to pay with your phone with whatever app you came in with. And they want to basically completely make that into like a seamless experience, which their stablecoin could be a tool that they use to do that. And it is supposedly the fastest growing stablecoin of all stablecoins at the moment. That's what the crypto people on Twitter are saying.
Fiscal, you want some due diligence here, right? I could see a real world use case. So I've been out of the country 2 times in the last like 2 or 3 months. I know, nobody likes a bragger.
Yeah, weird flex, but okay.
Yeah. One was in Canada, a mile over the border, and the other was in the Bahamas. But either way, I still had to pay. You had to pay a foreign fee if you wanted to. I could have partaken in some of the Starbucks over in the Bahamas. It could have happened. And I would just end up having to pay cash because there was a $1.25 fee on the already $7 coffee. And then they wouldn't accept Discover. So I had to use my debit card if I were to. And then over in Canada, they just wouldn't accept Discover at most of the places I went to. Long story short, I think there's a real world use case for PayPal World, if I understand it correctly.
If you had it set as like your payment method, basically, like if you had, PayPal theoretically on your phone and they use some other thing locally, theoretically that shouldn't matter if the vision comes true.
What stage are they? And are they still in the early stages of this?
Extremely. Yeah. Like I think only just recently did they announce that they were going to have it be where you could transfer money between Venmo and PayPal, and they own both. So that should tell you how early it is.
Yeah. Again, everybody, I know like very little about PayPal besides the fact that I'm a customer. So take that in mind. What do we think if we want to get into like the nitty gritty of valuation while we are kind of on that topic earlier? I think we all can kind of agree, you all at least, that it's cheap. What are some solid valuation metrics to look at? We're not going to pull an Uber price to free cash flow because we read on this show. What are some good valuation metrics for the retail investor to look at?
So in this instance, the simple GAAP earnings is actually sufficient. I think it does reflect the economic profitability of the business. And you just got to watch out for any kind of like, this is on a year by year basis. There could be something that kind of throws things off, but for the most part, what PayPal has been through, GAAP earnings is actually fairly decent to work off of. As kind of a gauge of valuation.
And really, there's not a huge difference between the earnings and the free cash flow at the moment. It looks like so. I mean that's usually a pretty good, in some cases at least, a pretty good indication that the earnings is like a real reflection if they're not like some kind of a huge wild difference between the two.
Yeah. They should, exactly. Even in most other businesses, over the longer term, if you take like a 10-year view, they will sort of like ebb and flow and match each other. So like the corrections in one of them 1 year, followed by the next year, over a long period of time, it does end up matching, which is why you don't want to overstate or understate in your evaluation, the importance of something. But I was just looking real quick at the partnerships. So Mercado Pago is a very big one as far as early partners for PayPal World. But I just want to clarify that. I didn't want to say it and then it not be true because I thought I remembered Mercado Libre partnered with them. But valuation wise, I think for a growth rate, you really just have to basically hope for something in the high single digits. If you get into the double digits and sustain there, I really don't see how you do poorly with this investment. There's other companies that are share cannibalistic that are actually growing earnings at a similar clip that people also think are cheap online. PayPal is not a SaaS tech company, so it is, probably deserves a lower terminal multiple because it is tied to consumer health and spend. I wouldn't fight someone on that. But at the end of the day, when we're talking about, raw earnings power or raw growth, it's healthy now. If we can expect high single digits, low double digits, you should do well. If it accelerates from there, you'll do very well. So that's kind of where I'm getting at with anyone's assumptions out there when you're doing your valuation. I think that's kind of what you have to expect. If you accept any deterioration scenario, then you're probably it will be probably a poor investment. So because remember, the buyback can only save you for so much if the business is deteriorating. If you have stagnation with the aggressive buybacks, like Frozen IKEA said, or sorry, Fake Alias said, so many people I interact with. First, Fake Alias is like, what the heck, man? If it stays at this level for too long, the buybacks will do their work on it. We've seen other share cannibals in the past where the revenue doesn't even grow that much, but they're able to repurchase so many shares, and the core business still is just growing, just not that much, that if you give it a low multiple, I mean, you're gonna see the damage over time. So,
I think like Dillards and AutoZone both fall into that, if I'm not mistaken.
Mm-hmm. Dillards, what weren't they trading at like single digits when they started the buyback program?
Yeah, I know it's insane when you look at the stock chart of Dillards. It's just like it's completely bananas. Yeah.
It's also
like you look at even the 5-year on Dillards, they were under $50 a share. Now they're almost $700 a share in just the last 5 years. And I don't think that's because Dillards has had phenomenal growth in the core business. I doubt that very much. I haven't really examined them that closely, but I'm pretty sure it's mostly the buyback.
Yeah, I think from what I recall, they were even back then trading on a forward basis in the low single digits. And I mean, I can already see. Yeah. Like, so forward EPS back in 2021 was like in the almost $40 a share. And they were trading in like 2021 at $57 a share. So like forward P was like ridiculously low. And then Dillard's is like, okay, you want to trade us like that? So,
by the way, shout out to Dillard's. I've shopped there before. I like their clothing. It's very nice.
It's no Target.
It's no Target. I'll frame it in another way for the audience might like this framing too. It's if you're cheap, I like to say this a lot to Andrew and Garzi. And we say this as like a mantra at this point. If you're cheap, it's great that if the management knows they're cheap, they're doing something about it. I can't stand a management that says, oh yeah, we're cheap, and they don't do anything about it. So when you kind of look at the economics of this, it's like if I'm trading at 5 times earnings and I know as a manager that my earnings are going to be relatively stable. Let's pretend it doesn't even go up. Let's say just stable. On a return on investment per se, if I'm trading at 5 times earnings, you can kind of think of it as I'm getting a instant return on that investment of 20-ish%. And then if my price stays the same, even as I buy back those shares, then all that's happening is the earnings yield continues to go up. Now, the key assumption I made there is that we were stable. If I'm a manager and I don't think that the business is going to be relatively stable, the calculus gets a lot more difficult. We have to start thinking about relative to the decay that we're going to see in the business. Will the buyback actually make that much of a difference? And if you were the owner operator, you'd probably, if the decay is going to be strong, you'd say, I'd rather, in that case, have a dividend. I want to cash out. Or in the case of being a public shareholder, you sell your shares before that happens. But if the business is growing too, then a buyback can be very helpful. And it's just like a coiled spring. It's just a matter of time, but most people probably won't have the patience for it, and that's fine too. Like I said, cheap can stay cheap for a long time, and there is opportunity cost at the end of the day. So it's something everyone has to think about. But you've done very well this year, Fiscal. So it's like opportunity cost, opportunity cost. Like
Exactly.
who cares?
except for TSSI.
Yeah, timing's not.
But no. Like year to date though, we're still good. We're not at like 50% anymore. It's more like 42 or 43%. But my steak too juicy, my lobster too buttery.
Laughs and rich. What are some of the contributing factors? Again, I don't follow the stock very closely. For all I know, the reason that the stock is down is because Arya is making bad tweets about it. What are some of the leading factors to negative sentiment right now? Not including this good performance that I'm looking at on chat.
Well, so I keep hearing that nobody's using PayPal anymore. This is this is what I hear. If you people on Twitter have their opinions heard, yeah, nobody uses it anymore, and it sucks, and they don't innovate enough, and the fundamentals are deteriorating, and the competition's eating their lunch and taking away all of their ability to have any meaningful margins. It's a race to the bottom, you name it. These arguments Venmo is eating their lunch. I heard that one a few times, but I made fun of people ruthlessly for it, so I don't hear it anymore. But yeah, I mean,
I've got one for you guys. Low user growth. I think that still persists. I think that's like the biggest bear case I can find with it.
Yeah,
I think it's only 1% year over year.
That falls under the nobody uses it anymore argument, I think. But I mean, I really think like any user growth kind of tells you like, well, it's not that nobody.
Would that be like active accounts? Because I'm looking.
Monthly, I think they do monthly active users is their KPI, if I'm not mistaken.
All right, I'm looking on Fiscal.ai.
Link in the description.
Link in description. We need money. Yeah, 1.6%. Net new active accounts.
All right. Is there here? I'm gonna zoom out to show you like where I was bearish, because that was another point that went away. So I'll pull up also your sponsor, Fiscal.ai, link in the description below.
Our sponsor.
No. Affiliate. And if you subscribe to Cashflow Kings, they get a Black Friday discount plus the
it's very good
Black Friday discount right now, 2 days. So let me pull it up. Financials. So custom KPIs, and here we go. Active accounts. Okay, so share screen. So where I was bearish is yonder years, right? So and this happened, right? So let me zoom in for the audience. I'll just kind of shorten it up. If you guys can see there, from 2022 to 2023, what do we see? A decline in users. Now, one of the things that I mentioned back again in like the bearish points is like, hey, the user quality, like how they grew, was very promotional. And so have any of you studied the case study of Kmart? If not, it's a very brief one. So basically, in like when you either in business school, et cetera, it's like one of the case studies you look for is the wrong kind of customer to attract. So not all customers are good customers. So people think this when they're doing business, that when you just run promotions, you attract, certain customers. Again, the Kmart case study is obviously not for Hugo doing it's not a good thing to be called that, because their strategy was absolutely awful. The customers they got were the worst kind ever. They're the customer that will only shop there if there's a promotion. They'll only shop there if you give them something. You don't want those customers. You actually want your competition to get those customers. Those customers will bleed them dry. Who you want is the customer that enjoys using the product and uses it again and again and again and comes back. So a lot of the growth that we saw, particularly in the pandemic era, was a lot of people that were a bit more on the promotional side. Like they were looking for those promotions. PayPal was offering those promotions across their platform. And again, this stemmed throughout the entirety of PayPal, where again, you can kind of see the theme here. So with Braintree, we will take whatever as long as we grow volume, revenue at any cost. So that culture was very detrimental. That's again, back to the Kmart case study. It's like, you don't want to be that. So then new CEO comes in, throws that out. Obviously he probably learned this in business school. He's like, that's stupid. Or at least it should come naturally to you. Because I think for the most part, I'm saying this out loud to everyone here. And many of you who've never heard of it, you're like, that makes a lot of sense. Because it does. It's actually very intuitive. So right here, what we saw with this decline, and me going like, haha, you see that, declines are coming. That of course was very detrimental to how the optics of PayPal, because what comes after user decline? Revenue decline. So as a potentiality. So there's a lot of fear that, kind of stems from that. But this decline, of course, came from the actual churn of these promotional users. And then PayPal stuck with their more core users. And from there, you actually see some growth. And if you continue to see some growth on that, I think that's pretty positive to healthy, because I don't think you need to, kind of assume too much growth going forward in the user count. You just don't want to see decline. But that's what I wanted to showcase here, is that before, when we were looking, you weren't seeing this decline here. The decline moment happened, and that was a freak out moment for PayPal. People are like, oh my gosh, what's happening? But yeah, that's the gist there.
Sentiment.
Nothing good ever happens in a Kmart bathroom. That's what I grew up with Kmart in the 90s, and it was usually Kmart was the place you wanted to kind of avoid. If they weren't running a promotion, it just wasn't very fun to be in a Kmart.
No. And speaking of, I guess the other bearish narrative is consumers dead.
Yeah.
I was reading some dividend tweets today that said otherwise, Fabio.
What is it? Yeah, I know. Well, actually, and another guy on
Black
Twitter
Friday
said this is actually a recession signal that there's record-breaking Black Friday sales, apparently.
We can have a conversation about this. This has been irking me so badly.
The dead consumer hypothesis that's been
dead consumer hypothesis. Actually, can you pull up my tweet on the Google search? I got a credit to one of my subscribers who gave that to me. I just took their photo because it's hilarious. But the dates are super important.
It's the Target one?
Yeah, it's the Target one. Just the photo is important. So this irks me to no end. So everyone, please pay attention to the dates and the titles as well. So we'll start at the top. Why American consumers are choiceful right now. September 15, 2024, for those of you who are listen only. CEOs have a new favorite word, choiceful. November 20, 2023. Target cuts its full year guidance, warns that consumers are choiceful. November 19, 2025.
Oh.
Okay, so
every year.
Every single freaking year.
Rant needs to cut it out. Good Lord.
No. So it gets better, because I was sharing some thoughts in the server today on this very topic, because I went through a bunch of transcripts. The wonders of AI. It allows you to read at a much faster pace, condense information, and just go from there. Oh my gosh, it's they say AI is a bubble, as Stabula would say. And they say AI is the bubble. Okay, so a few things with consumer recessions or consumer-led recessions. Well, let's start with the first thing that typically, not all the time, but typically you can see a decline in business spending that precedes the consumption spend drawdown. This makes a lot of sense. Businesses pull back on spend. That means a lot of lack of investment in, employees, and then people pull back on spend. So the flow makes a lot of sense there. Okay, let's start there. So typically in a pullback, you tend to see declines in a few discretionary services. So we have vacations, luxury products, restaurant meals, clothing, fashion upgrades, electronics, home decor, entertainment, and yeah, that's it. All right, so those categories you tend to see a decline. Well, the wonders of the public markets is that we have everything available to us, and we'll get into the restaurants one because that's where some people have a point, but I can address that with other ones because you got to be very holistic with this. Okay, so on to the LVMH. And by the way, I'll just say, to save some time, Capri, I looked into Capri, I looked into Tapestry, and it's more or less the same copy-paste, paraphrased comments on resiliency. So in the recent quarter, LVMH described solid local demand in the United States, noting that North America contributed to overall growth, and after being softer earlier in the year. The company characterized trends in the U.S. as improving sequentially, Q3 growth in the region, and still, even within the more challenging macro backdrop. Okay, and again, like I said, Tapestry, because LVMH is middle class or aspirational luxury, they call it. So maybe arguably upper middle class. You're talking about $1,000 to $6,000 for a bag. Aspirational luxury, not so-called true luxury like Hermes, but aspirational luxury. Then you have what's called attainable luxury, and that comes with Tapestry brands. Think of brands like Coach. It's not necessarily like crappy quality or anything like that. It's just more affordable brand. And so we're talking about handbags now about 10 times less, or 1/10 the price. So anywhere from a couple $100 to $500 to $600 for a handbag. Said the same thing. Strong consumer, yada yada yada. And then so we covered kind of the luxury segment. So then you say, okay, well, what about technology, stuff like that? Well, actually, we just got one of the most popular technology firms report on the consumer tech consumption. Oh,
TSSI?
Apple. What did? Oh. No. Well, but TSSI, we can talk about if you want.
We'll later.
Always.
But if you want to do a members only.
Oh.
Members only after hours.
Oh.
Right? So, the CFO, this is Apple, highlighted in the United States for both overall revenue and services were very strong. Vast majority of markets we track list in US among the key growth markets. So people are spending on their $1,000 iPhone. And is that just only the upper class that's making up that? No, obviously not. So basically, yeah, I'll save time on that. And then what about travel? So based off this theme, I guess you guys can guess what travel said. I looked at Expedia, Booking, and Airbnb. Essentially, again, to paraphrase to save time, U.S. vacational rental consumers is still very strong with resilient demand, even among some stronger than expected behavior in Q3 2025. Premium travel and U.S. domestic trips are holding up particularly well. Longer stays and longer booking windows signal confidence rather than stress behavior. Okay, well, so I just went through a bunch of the categories. And then, it gets even better. It does get better because then the narrative goes like, that the low-end consumer is suffering a lot, right? Well, we have some data points that suggest that, right? We have Walmart, who's been saying consumers been struggling for like the past 4 years. No, they have. You can go back each quarter. I was talking in 2023 about Walmart's earnings call saying, and I was at the time going like, whoa, they're saying stuff here. We got to watch out for this. But turns out this has been an ongoing trend for a very long time. Now, my theory as to why that is because we are using tough comparables of a stimulus environment. Because I went back even in time before that and went to Dollar General 2017. I picked a random year, random quarter, 2017. Guess what I found? Dollar General said low-end consumers struggling. So they've been struggling since 2017. Well, go figure. If you're poor, you're in a perma recession.
Yeah. When is the low-end consumer not struggling is the better question, right?
I want to also add another talking point, which is something that I saw in Time Magazine recently, which was this very
You just made that. All right. You just made that. The wonders of AI is also my hell. Choiceful consumer, my ass. I hate that word so much. But anyways, so you get this comment from Ross, TJ Maxx, etc. So in particular, they noted the lower income shoppers drove same-store sales growth in most areas. So this is for Burlington, TJ Maxx, and Ross all at the same time. And they get this for food, right? So this is where some people have a point. They'll say, well, look at Chipotle. Look at all these consumer restaurant stocks, right? They're all down. They're all struggling with same-store sales growth. Well. If you pay attention to a company called Toast, disclosure, long Toast, they said on their same-store sales within their network, it was going up. Well, what can we decipher from this? And by the way, I have Brinker International, the owner of Chili's, reported same-store sales growth across all income levels, in particular households that make under 60K.
They own Chili's, wasn't it?
They own Chili's.
Yeah. So I've heard that there's been kind of a shift to more of the fast casual because fast food has gone up to the point where what you get for your dollar is actually better at like a Chili's than it is at like a McDonald's now. And even in my own life, I'm much more likely to call up a friend and be like, hey, let's do lunch at Chili's versus let's go through the drive-through. Like, just doesn't happen.
What's wrong with being a date through the drive-through at McDonald's?
But literally, like, you go through the drive-through and you do spend close to as much as you do at a fast casual place, yet the experience is much better. And so people are going to pay the $5 extra and have a better overall experience. It just.
What do you mean by like better overall experience? Because I feel like there's a lot of people that like would much rather take food home and
like the one. I think you do get more food for the money at like a Chili's. All right. Have you ever been to Chili's?
No, I'm uncultured.
Okay. I recently went for the first time this year.
All right.
Okay. I had to see what all this was about.
When we do the meetup, we should go to Chili's, get some margaritas.
All right.
I'm down.
All right. Sounds good. But yeah, like you get very generous amount of food for the money. In fact, I think for most people, a typical sized meal at Chili's will have enough leftover for you to maybe have like a snack later or whatever.
Midnight snack.
Yeah. And, your drink is, your soft drinks of choice are bottomless, for whatever you pay for them while you're there. Certain appetizers like the chips and salsa are bottomless once you pay the initial price for them, and you can share that with the whole table. So like, it's very generous, and the atmosphere is usually bright. They usually have, depending on, it varies from store to store, but oftentimes they have pretty good music on. They have drink specials where the drinks aren't, there's usually some option that's not too terribly overpriced that has tequila in it and it tastes good. It's just better. It's more social too. Like if you want to spend time with friends, you can do that over, some chips, some guacamole, some margaritas at Chili's a lot more easily than you can trying to like do it at a McDonald's or a Burger King or even a Chipotle. So yeah, there's definitely, and this is actually, I've heard it's Gen Z that's really driving this, this change. Yeah.
Yes. Can I also say something? Because you guys are long this company and you guys might like this. So the other thing, and I see this a lot, especially when I was previously working. So you know what recent infrastructure has made it so convenient for me to order anything I ever want from any restaurant as long as it's part of their network, and I can just schedule it to be ready at the time of my lunch, so I don't have to Uber. Come on, and I can get it delivered to me. I can. So now suddenly the whole pizza, convenience of like pizza could get delivered, but most other foods can't. Now suddenly anything could be delivered. Anything could be order for pickup. Anything, any restaurant. So I go on my Uber app right now, and I utilize this all the time. I'm actually very avid Uber user.
I used it this morning.
Thank you, guys.
So like, why on earth would I eat McDonald's when everything else is open? And the convenience factor is really no longer that important to me as much. If I need to eat at my desk, I do not need something as trash as McDonald's on my desk to eat that slop. I can go eat anything I want. I can eat, because before it was like, but I don't want to, wait in line. I don't want to sit down and order. I don't want to have to sit there and wait. That's the biggest friction before. But now I don't have to do that. Now I just go, I want it here. I want it ready. I want it delivered at this time, or I'll pick it up.
Yep.
But that, I think, has changed things a lot. And so I think what we're seeing here, and based off Toast's commentary, based off Chili's commentary, it's exactly that. It's people are saying, why on earth would I pay this price for this inferior product when I can pay slightly more in most cases? Because I wouldn't say it's exactly comparable. I guarantee you, like we go to McDonald's, we can.
It's more that
meal.
it's gotten so close that it's like, well, I know what I would rather. It's more bang for your buck, essentially.
Yes, exactly. And I do that calculus, and I'm not a low income person. I just go like, why the fuck would I eat, McDonald's when I can just, or Wendy's or whatever, any of these slop locations, when I can just go to any of these other locations and then get what I feel like is a higher quality meal. It's the obvious choice. You have to actually make an argument for me right now, I guess, to go choose the other one. It's like, I guess because of the nostalgia factor of a nugget, it's like,
yeah.
Whatever.
You ever experienced the pleasure of getting $23 worth of food and about 3,000 calories worth of seed oils at McDonald's and pigging out to some outdoor boys? Have you ever had that? It's a nice night. It's a very nice night.
Well, you could get
the last time I regularly ate at McDonald's was when the actual dollar menu was still a thing, and I would get like a mukbang worth of like quarter pounders and McChickens and so forth for like $10. But nowadays that is just not feasible anymore. And yeah. And by the way, I was way younger then and could get away with that a little bit more easily. Now that would probably kill me. I'd probably have a heart attack in my sleep if I tried to do that now.
Members only. I'm gonna post my McDonald's order. You guys
By the way, though, the same thing here. Where I live, it's more. I think Taco Bell is probably suffering pretty bad from this whole thing because we've got literally littered on some intersections. You'll have 3 different Mexican drive-through places that are all better than Taco Bell, and you can again with Uber order any one of them anytime you want, and it's super convenient. And it's like, why on earth? Like Taco Bell might be a little cheaper, but these are much, much better food. So it's like, why would anybody want Taco Bell? And a lot of them now stay open 24 hours and such. So it's like, what's Taco Bell offering, right? That these other places can't offer.
Yeah. I know a lot of people that are in the restaurant space. One thing they kind of talked about with them, and on this, like, it's not so much a phenomena, but it's an interesting thing to observe. It's like, these taco restaurants, and they're just a little bit more expensive than Taco Bell, but it's not really that they're making less money. By the way, it's actually interesting because like the infrastructure that has supported restaurants has gotten a lot better over the years. So there's a lot of tool sets that are available to restaurant owners that wasn't available before, that has made them individually a lot more efficient. So like this thing with Toast, like Toast is one of the marvel products for restaurants. They love to use it because of all the efficiency drivers it's actually given the restaurant operator that have saved costs along the margins that previously might have been only exclusive to, a greased wheel, enterprise, right? That you would think so, and that they could afford to build their own in-house product. But then all these new products have started proliferating, and it's not just Toast. I'm just kind of addressing one aspect. But if you wanted to yourself build a well-oiled machine of a restaurant, it's never been easier today than before, at least figuring out logistics, inventory management, employee management, all those things. And in the restaurant industry, every little cost counts. You can't let anything kind of get away from itself. So the tool sets that exist today are really, really powerful. So kind of going back, what I see is exactly that. Because of what Toast is saying, I think what's happening is people are saying, why would I eat that Chipotle burrito bowl when, they kind of skimped out on some things, and hey, there's like a local Mexican place nearby, just so happens to use Toast. So I'm going to register as a same store sales growth on Toast. I'm going to go there and I'm going to spend my money there. rather than this,
It's
like
funny because in these,
soulless
I
corporation.
actually I look at their POS now when I go when I do go through the drive-through or when I see Toast all over the place with it.
Yes, you do.
Like, just so you know, like, I've been wanting to share that because I've just because of all the talk about PayPal and Fiserv and Toast and all of these different things. I now am like looking for like, all right, what brand is that device they just had me tap? And it's interesting when you actually see it out there, that boots on the ground due diligence.
Yeah. And so I don't know if you wanted to get into like with how it pertains to PayPal, like with the whole other adjacent fintech discussions, like what happened, what went wrong, because we're talking about Toast, and you just mentioned Fiserv, and Fiserv blew up recently.
The other buyback story, it's better than PayPal, they said.
It's better than MasterCard and Visa. It's better than SHG, apparently. We could sell SHG and a Roth IRA for it. Wonder who could have done that.
Who
By the way, I
did
think
this?
Visa's looking good right now.
I'll put it in the private chat.
Visa, I do agree with that, Peter. Visa and MasterCard both look good on a risk-adjusted basis. I think they're good buys. Good buys. But yeah, with Fiserv, this was another one that I was not a fan of. For one, right? You just listen to their earnings calls, and they had a leverage target of it was, I think, 3 times debt to EBITDA. When I listened to that call and they stated the target, they were at 2.9. Yeah. So there's only 2 ways you get out of that. You either break your target and you go above that. But the thing is, as soon as you break above a certain level, 3 is actually particular. A lot of funds actually will not invest in you. It's actually a pretty common cutoff for a lot of institutions. And when I say institution, I'm more so talking about hedge funds. So buy side will just say, no, too much. So that's actually where the magic number 3 comes from for a lot of these entities. You'll notice the number 3 times debt to EBITDA thrown out a lot. That's why. Because they're trying to be under a level where they're still quote unquote buyable for a lot of buy side. But the whole Fiserv story, it's like, okay, they're already levered to the tits. Where are we going to get the extra money for the continued buyback story? I'm usually not a fan of levered buybacks. A lot of their leverage came from the First Data acquisition. Fun fact, I was a shareholder of First Data when they bought it off me. Fun fact.
They were your exit liquidity.
They were. They definitely were. And Fiserv, they had an interesting kind of mixture of businesses, right? Because they have the cores business, which I am long probably one of their greatest threats they have in the core banking business. And as long as that business remains stable, they probably aren't at risk of bankruptcy. But if that ever actually does get disrupted, that is a possibility. They probably will go bankrupt. Now, that has yet to be disrupted. So if that doesn't go get disrupted, they will not very likely go bankrupt. Then the other business, right, the merchant acquisition business, that kind of stems also in this POS. That's their growth business. That really isn't growing too much because it's facing pressure from Toast and Square. So how that compares to PayPal is like we have 2 different stories or 2 different stocks where they're both a buyback story. And oh my gosh, he did. Oh my gosh, I just saw that. That's I can't unsee that. Yeah, so you're set up for basically any sort of little failure that occurs in the business operations, any hiccup. There's no let's say other way around it besides growth. You have to grow your way out of this problem. And yes, like the prior management team had some sort of like lofty sort of like outward expectation on what they were going to grow at. And it looks like they're not going to grow anywhere near that, which of course is a problem. And then that's also bringing into question the credibility of said management team. Like the current management team is of course new from the prior one. but that doesn't really, let's say, excuse the fear that's been brought up by this. Because when you're dealing with leverage works both ways. It introduces a tremendous amount of risk. So all that to be said is that PayPal's buyback is much more sustainable and healthy. Fiserv's buyback was not only done at much higher multiples, it's also has effectively no further room to run. So they have to focus on debt pay down. And there's a lot of companies out there that frustrate me to no end, that they go do this debt pay down and don't buy back stock, but they could buy back stock instead of doing debt pay down. In Fiserv's case, they're going to be, BTI. Dude, BTI could be $100 stock if they just did the buybacks like crazy back in the day, because now they're going to finally do the buybacks after the stock price has appreciated over 100%.
Could have been 200.
Could have been 200. It was an example of a company trading at 5 times earnings, still growing, and every dollar you put towards the buyback was effectively, you could think of it like a 20% return. No, they decided not to. They'd rather pay down low interest rate debt. Okay. Anyways, don't get me started on that.
It's that's the country that produced Fraser pairing. Like,
yes.
What did I see with Pat Gelsinger today for a wrap up? There's something on CM with Pat Gelsinger I saw.
It was. I think it was a joke. Is that the Pope blessing into?
Oh yeah. It's great. Do we want to do a TSSI after hours for members only?
I do.
I'd be down.
All right. We want to conclude anything with PayPal? Anything we didn't cover?
I'll let the others go first.
Peter.
All I'll say is I tried. They had like a promotion for agentic commerce on Perplexity AI.
Mm-hmm.
It was like 50% off if you buy it on Perplexity AI. So check it out.
Oh yeah, the 50% cash back thing, wasn't it?
I think it ends on December 1st. It was okay. It wasn't like the greatest experience, but do some more DD on it.
Fiscal.
Yeah, that's true. I have seen a lot of stuff about their partnership with Perplexity. I don't necessarily care as much about that as I do the Braintree and the Venmo piece. I think that's a little bit. Maybe we'll see the fruits of that a little bit sooner than we'll see the real fruits of any AI partnerships. But then again, they could prove me wrong.
Yeah.
But yeah, I think we'll really see the proof in the pudding probably in Q4 results. And I also have a prediction that if the stock breaks triple digits, suddenly, all of a sudden, it won't be a dead company that nobody uses anymore. And a lot of the different opinions that we're seeing out there miraculously will fade into the background, and nobody will hear from them again on how bad PayPal is. That's just a prediction I want to make, but it has as they get there first.
Till it derates back to the 60s after it hits 100.
Yes, indeed. Yes. While it's under 70, it's PayPal. Everyone knows the rules. And when it's above 70, they call it something else. I won't say here. But
It's inappropriate.
It's inappropriate. Yes. And so kind of to wrap things up, I mean, you got, as long as the business does not deteriorate, right? As long as you have stability in the core products, and then you have some growth in the other products, Braintree, Venmo, etc. I think you got a really good setup here. The buybacks will juice those returns over time as you start to kind of develop this coiled spring. That will happen because you'll never be the last shareholder standing. That's never happened. I've never seen it. There's not a case study for that. But I guess this could be the first time. I highly doubt it. And so if this is still a growing business, just that alone, you have really an unlevered business performing a pretty attractive buyback program. You get a little dividend if you care about that. I know you guys don't, but out there, if you care about that, dividend's probably going to grow. Dividend seems very sustainable and healthy. It's nothing crazy. I think it's 10% of profit. I would prefer it if they keep it at some sort of variable 10% of profit rather than systematically growing a dividend. I hate those. And then the consumer, as long as we don't see weakness in the consumer, which as I ranted a little bit earlier about, I really don't see it. I don't see any company, and that's excluding the other banks who have access to insights on consumer financial balance sheets, right? So their household balance sheets telling us that they're very healthy right now. Because to kind of freshen up on this, it's like you hear from all the companies that would know about consumer health tell you consumer's good. Then somehow, did you see that tweet that was like the earnings results from these retailers is very confusing. This economy is very hard to read because it's macro people that are saying like, they've been ranting the consumer's dead, the consumer's dead, the consumer's dead. They get these prints out and then they're like, what? They're spending a lot before the holidays? No. This economy is so hard to read. And then I responded, as a retort, very sarcastically. It's like, you clearly just don't read like companies' earnings.
Why don't you read?
Why don't you read?
Yeah, not reading is a theme.
I think people, like, to be fair, they are reading. They're just reading each other. And so it's like a massive like circle jerk of like the same people reading each other. And so one person says it, then the other person reads that and then believes it, then retweets it or tweets another thing about that. And it kind of just goes off. And then you're just like, where did this come from? Like, what are you listening to, hearing, where? And then you're reading, each of these companies' transcripts, and you're just like, strong, healthy, robust, resilient, strong, healthy, robust, resilient. And you're like, what's happening here? Because you even have Visa and MasterCard both say the same thing. Dave said on the low end consumer, and I just read to you on some of the retailers talking about the low end consumer, Burlington, Ross, TJ Maxx. They're talking about low end consumer. They're saying they're spending robustly, they're healthy, they're resilient. So because again, I hear the argument. It's like, oh yeah, no, the low end's bad. The high end, that's the only thing that's doing strong right now. It's like, no, I don't know where you're getting that from. I get it that maybe it's an idiosyncratic problem, right? It's your company lost the ability to resonate with consumers and is losing business. That could be true. McDonald's does not have a right to win. I'm picking on McDonald's, but I think McDonald's is doing fine. Like Wendy's, QSR restaurants now have like this right to just win customers. They have to compete against what exists and what is coming and what is new. And so, yeah, anyways, enough of that. PayPal will be fine in that view. If that changes, because it could change next year, because everything I'm saying now is only true up until this day. Next year, we could actually go into a recession. Who knows? I have something to talk to you about with Fiscal, with certain stuff that because I saw some interesting data recently. But another time.
All right, Beater, where can the people find you? Obviously, Discord, Reddit / Antifa. What else?
Reddit?
That's a joke.
Yep.
He doesn't deny.
Yeah, you're right.
There you go. We know where to find Beater. Fabio, obviously of the hedge fund. You want to share the qualification? $250 you make a year or whatever, something like that.
Yes. Yeah. No. I have to be serious about that disclosure. But no, I'm not. I'm not advertising the hedge fund. Only just sharing my personal opinions here. And no, you need to be a qualified investor.
Yes.
Accredited. Sorry, not qualified.
Yes.
Accredited investor.
Make sure to follow his LinkedIn too.
You can follow me on X. You can follow me on LinkedIn. You just won't find much. You can follow me on X, where I'm active. And you can follow me on YouTube, which I will be more active. I keep saying I will be, but I'm so lazy with it.
Will we get him more active before GTA 6 comes out?
It's a new Cal sheet prompt. Will there be 10
Yes.
uploads?
Will there be more uploads?
Cal
And
sheet
then
hasn't
your
uploaded.
Discords. You can
Yeah.
find me in both their Discords.
That's true.
All right, we're gonna do a little after-hour special. Nothing too long, of course. Just discussing a certain ticker that rhymes with EEI. So go check that out. Become a channel member, $2 a month. Get unlimited value. Watch episodes that nearly got me killed. Lots of value there. So go check that out. All right, smash the like button, subscribe. We'll be live with that soon, and of course, cash flow is king. Oh yeah.